There are two major financial statements for inside and outside review. One is the balance sheet. The balance sheet is a picture, a snapshot of a business at a point in time. First of all, financial statements are always in the form of generally accepted accounting principles. That's GAAP. Basically, what GAAP is about is explaining the numbers and summarizing the numbers of a business in a way so that there's universal understanding. GAAP works on what they call accrual basis accounting. And what that is that the revenue is recognized when it's earned. Expenses are the same way. Expenses are recognized when they're incurred, not when they're paid. That's one of the basic principles of GAAP reporting. It separates itself from another basis called cash basis, which most people in finance basically consider meaningless, and it's used a lot with small business. So for access to capital, we're always showing our financials according to generally accepted accounting principles, or GAAP. Financial statements are broken into two major parts. You have what we call variable costs, which are your costs that relate to revenue and sales. So it generates a thing called gross profit. This is important because when we evaluate these costs, and when bankers evaluate these costs, we don't evaluate them in quantitative terms, we evaluate them in relative terms. As your sales go up, you would expect that your costs would go up. So we're looking at a percentage. The percentage in this arena is extremely important. What is your percentage of profit to your sales? The change in gross profit is extremely important. Is your profit going up? Is it going down? The next group of expenses are your overhead, which is mostly fixed. This is your rent. This is your basic administration costs. It doesn't matter if you sell $1 or 10 million. Your rents always do. And these become important for analysis that financial personnel use. I'll explain later on in the area of break-even analysis. What you get there is gross profit. A common term is EBITDA for this. And it's earnings before interest, taxes, depreciation, and amortization. The reason this is important is because it shows the basic earnings of the business without these burdens. Tax is a burden that's imposed usually on income, interest on debt, depreciation on physical plant. These could be a cash cost, they could be a non-cash cost. EBITDA is important to investors because there's a lot of things you can do if you establish EBITDA before you establish interest and taxes. The next thing is cash. Cash for investors is always king. If your business is starved for cash, undercapitalized, its chances for success greatly